In the first videos, we talked about interest rates and inflation, and the bond market outlook and the equity market outlook. In this final video, we want to go over the slides covering the psychology of staying invested, which is obviously the most important part of any plan. The best investors, they continuously act on a plan. Failed investors are constantly reacting to current events. So with that being said, let's get into the slides. This first one is just showing the general roller coaster that the average person goes on when they think about investing. So right now, let's go back to COVID, we saw that the market was nervous, COVID, panic-stricken. The market was down 30% in 30 days, and things went plummeting down. Everyone's defeated, and they fled to the safety of money markets. And then the market ripped higher and had its highest 54-day return in all market history. And at that point, after the market had already gone higher, then they started feeling confident, overconfident, and that's when they started piling back into the market. And then in 2022, interest rates climbed and the market went way down, and they continued riding the roller coaster again. As the market bottomed, they sold out. As the market has rebounded in 2023, they have essentially missed the rise. As investors, we can't do that. We have to keep an even course, because ultimately that is the way that we remain successful over the long run. But that's easier said than done. Headlines will always look negative. When I say headlines, if you read the financial news, you're going to see it all the time. This is not news to you in any way, shape, or form. This is just a screenshot I took from Business Insider, and at top says, deflation could soon hit the U.S. real estate and stock price are at risk of crashing, economists say. A recession is only delayed as the economy continues to lose steam. Here's exactly how 8 top strategists and money managers recommend investing in this turbulent market. Bonds are flashing a warning on the mounting U.S. debt, and markets will be rattled if Treasury yields rise once more. It's all scary stuff. It's always going to be scary stuff. And it doesn't matter what day you're looking at it, they will always be negative. Anytime you go through a recession and things start to rebound, the headlines will start to read about double dip recessions, and it will always be, when is the next shoe dropping? When is this big scary thing coming? Because financial media is designed to sell ads and not help investors. So again, I was listening to someone the other day, and they said, if you want to hear the bear case, just talk to the person next to you, because the average person is very scared of the markets, very bearish. And so as investors, it's very hard to stay optimistic. You seem like a crazy person when you think that everything is going to get better, but the reality is, it's the truth. Optimism historically has been the only reality. And so when we're looking at stocks for the long run, staying the course, what we see is that in any 1 year period, equities, and this is referring to stocks, this is referring to the S&P 500, but when we're looking at a stock portfolio in any given year, it could be up 47% or down 39%. This is volatility. Obviously, nobody thinks of the up 47 as volatility. They only think the down 39% in a single year is volatility. They look at the bonds and go, okay, we could be up 43% or down 13. That seems pretty good. Obviously, in today's interest rate environment, we're not going to get up 43%. And a 50-50 portfolio evens things out. So this is where diversification plays into giving you the upside that you're looking for while minimizing the downside. As we look at 5-year rolling periods, diversification helps keep us positive over that 5-year period. But here, when we get out to rolling 20-year periods, these equities, which looked incredibly volatile over a 1-year period, actually are less volatile in the sense that we care about, in that they have the lowest downside over a rolling 20-year period when we give them the most time. This 50-50 portfolio is relatively close on the downside. We've sacrificed some on the upside. But again, when we look at our portfolios, this is why we weight more heavily to the equity side. It's not because of these 1-year returns. It's because when we start looking at longer and longer time periods, the risk of equities, the volatility of equities starts to get diminished. And when we use our bond portfolio, it is simply to further hedge that the shorter stuff can be managed through as we're taking distributions and retirements and things like that. But for longer term investors, there's less risk in equities than there is in bonds or even in a diversified portfolio to some extent. But the important part is this only works if you're staying invested. If you are constantly getting in the market and then getting out of the market, getting back in and getting out, you don't get this same rolling 20-year consolidation in volatility, because every year is a new period, because every day is a new period that you're getting in and out, which is why we never try to time the stock markets. But volatility is going to be a thing. Volatility is normal, and so we can't let it derail us, because as much as I love stocks for the long run, they go down. They go down hard sometimes. In fact, we've seen double-digit declines in 24 of the last 43 years, but we ended positive returns 75% of the time. But that also means that we're negative 25% of the time. So 1 out of every 4 years, we're looking at negative returns. 1 out of every 5 years, we may be looking at a full-on bear market where the market has gone down 20%. But in any given year, the average decline from peak to trough is about 14%. Last year, we saw the market go down 25%. Year to date, and again, these numbers are through the end of July, we saw the market go down 8%. It would not be surprising at all to see a decline of 14%, because that is the historical average. But just because we get those declines doesn't necessarily mean that the market is in trouble. And it also doesn't mean when we see the market go down 1%, we get out because we're waiting for it to go down 14%. Sometimes those declines don't happen. Sometimes it goes down less, and sometimes it rises more quickly. But ultimately, we just have to, as an equity investor, we have to prepare ourselves for these drawdowns and understand they're going to exist. And it's par for the course, and it's the reason that stocks have value in the first place. If we didn't have these occasional drops, then the stocks and treasuries would all have the same returns. So when people get scared, we get greedy. When people get greedy, we get scared. If we are a long-term investor that keeps reinvesting our dividends, we're excited for these stock market drops because it means we reinvest at lower rates. And if we're taking from our portfolios, we just make sure that we have enough other assets in our portfolio, money market and other short duration bonds, that we're never forced to sell stocks when we're down. And if we can do that, ultimately, our plan is going to succeed. Now, the sleep at night factor, every seminar we've ever done since I've been with the firm, Bill Payne before me had his man sleeping at night, and we're going to keep that because ultimately it's the biggest factor in investing. If you can't sleep at night because you're scared about the things you own, you're going to make bad investment decisions. When things get scary, you're going to lose sleep, and when you lose sleep, you sell because you want to be able to sleep, and you're going to sell at the worst times. You're going to go with the money market at the worst times. The market's going to rebound in your face, and you're never going to catch up. So ultimately, my job, our job here as your advisor, is to make sure that you're comfortable with what you own. You understand the risks that you're taking, and you understand the long-term plan and how it all fits together. By doing that, by making all those pieces work together, we can stay the course and accomplish all your retirement planning goals. So those are the slides that we covered in our seminar. Again, we have one more disclaimer, and then we've got our thank you slide. But if you couldn't make it, sorry we missed you, but if you have questions about this or anything else, feel free to shoot us an email, give us a call, book a meeting, and we'll be happy to go over all this stuff in more detail. Thanks. Have a great one.